to Damon Richardson at this point. He is going to be the master of ceremonies and bring us through a very, very exciting product that I think you're all going to enjoy. So, Damon?
I look at everybody in the room today, and I'm very happy to stand here and to meet all of you. The important thing about today, coming together like this, the way we are right now, is that we should all acknowledge that we are here, we are all working because we like to get paid. I think it's okay that we all admit that, to ourselves, to each other. You can just put up an imaginary high five if you are a fan of money and that's why you go to work every day. Because if you're not doing it for that reason, wow. I don't know. I've never met one of you before, and that's truly it. Could you please line up here because I have so many questions, just a ton. But for the rest of us, that prospect, that idea that this is how we support our lives, this is how we feed our families, this is really what gives us the ability to do all those other things that we want and need to do. We need to be effective at making money. And let's face it, in the real estate business today, right now, we have some problems. We have some definite issues. The inventory that you're representing on both the buying and selling side is challenged. The people that want to purchase these properties are also challenged. Not so much in the way that they used to be, where they just want to buy way more house than they can afford. And we still have some of that, but nowadays, it seems like everybody is just on this whale hunt for the perfect house. Because they've been watching HGTV for a whole 2 years. And they have done nothing but think about and dream of their forever home. And they even use the HGTV evil term, this is not my forever home. This is not what I see myself living in. However, this is what your budget says you can afford, so ta-da! You have to wake up for it. So just a quick show of hands. I know that this is a very painful part of your life, and maybe you don't talk about it with each other, but how often are any of you spending more than 60 days with any one set of clients prior to getting them to just agree to buy a single house that you looked at? Only a couple of you. So the rest of you guys are really lucky. 45 days or less. That's an amazing thing. All right? Not everybody, as you can see, is that lucky. And the problem that you're going to have when it takes more than 45 days is, guess what? That's 45 days that it's not possible for you to make any money. And on the flip side of that, for those of you that are not spending an inordinate amount of time, I bet you have the other problem. How often are you putting in offers and it just seems like, oh my God, it's like 1 out of 5. You put in an offer, didn't work. You put in another offer, didn't work. Okay, let's try the next house. Also, a non-starter. No matter what, there's an inventory problem that is surrounding us all. And like every classic snake oil salesman that's ever come before you before, do I have a solution for you? The good news is, it's a solution that actually does work. I'm a mortgage guy. And honestly, my partnership strategically is with Oxford. Right? So typically, I wouldn't have much of a reason to stand here with all of you because you're not primarily my problem. They are my problem. But together with our ideology of the true partnership, and that's the way we look at every single relationship. If you are Oxford's partners, Oxford is my partners, well then by default, the friend of my friend has to be my friend. And if I have a way that can help you, then obviously the benefit that I can bring to my relationship to you, to your day-to-day business, is something that can reflect back for Oxford as well, and that's the real reason why I'm here. So let's talk about renovation. And while we do that, let's talk about our friends, well maybe not friends of yours, but those lovely people over at HGTV. I know, I bring it up and I see the smirks and everybody tenses up a little bit. They've been a blessing and they've also been a curse. Whenever you see any person talk about or think about renovations, they get swept up by the romantic idea of it, but then the financial reality hits them square in the face, and you are standing there by a doorway going, this house is perfect for you, it's exactly where you want it to be, it's in the right neighborhood, the right schools, it's close to work, it's everything, and it's like $100,000 less than the other properties that you couldn't afford, and it still meets everything. But the big problem that you seem to have is, okay, it's cheaper and we can afford this one, but it looks like hell, and I still don't want to live here. And I know you said I can do some work and potentially it's going to be great, but it's going to take like another $60,000 that I don't have. Sure, I'm putting down 15%, but that's it. No more. There is no more money, so this does not work. And I'm not living here forever with this kitchen. Have you seen it? It's green. I'm not going to live here with that kitchen for a long time. This is not going to work. I'm sorry. Next house. Right? Oh, let's not even talk about those old houses with those bathrooms. First of all, they're small. There's not a lot of storage space in them. It's just always a mess. All right? But those homes, they exist in all of these fantastic pockets in these neighborhoods. Communities littered with them. They are the butterface homes. But instead of the butterfaces, but the kitchen, but the bathroom, but the storage, but the lack of a garage, whatever that person's, it is. But we've all sat there and looked at a client where you went, can't you see this is the right house? It is the budget, it's the location, it's everything else except for the beautiful amenities that you want. This is the only place that's gonna check off all those other boxes, but they just will not pull that trigger. And it's because they have issues. They can't see past it, and you can't sell the potential, it's impossible. It's amazing how in HGTV, everybody seems to go into the other pocket and go, the $50,000 to fix the house, I found it. It's right here. This house is gonna be perfect. We can make this decision. In fact, show me 3, and I'm gonna pick that one, and then we have the money. It's amazing. This is all gonna work out. In your day-to-day business, I don't think you have that particular conversation very often. But what if I told you could? What if we could make that conversation a reality? Not just reality made up TV, but real life. What you do every single day. And let's just talk about it, simple standpoint of numbers. So tell me, what's the average sales price here in Rochester?
152.
152?
It's 130.
130?
Yeah, in Monroe.
All right. Now tell me this, the distressed homes, all right, when they're absolutely distressed, they're going for a discount, they're probably selling, mid-90s, still
A little lower.
a little lower?
Depends on the property. Yeah.
All right, so
Neighborhood.
there's still an equity position though to be gained from these homes,
Absolutely.
right? So there's room. And you all are a bunch of savvy real estate professionals. That should be a weapon in your hand, and I want to help you weaponize that knowledge. So with renovation, here's something that can actually happen. You walk into this $85,000 abysmal property, but it just happens to be in a really great location that works for the client, and you go through what this home could look like once they make it their own. You have to immediately walk past the premise of the, of the current dire situation, and you gotta use a little bit of that twin magic. You gotta talk about opening up some of these walls, putting in modern flooring, what it would look like with this great open family living area, with the kitchen, the re-engineered, with engineered hardwood flooring. You have to be able to, sell that piece of potential, right? And as they're getting swept up into the emotion of all of that, you have to hit them with the reality. Look, this is a big renovation of this property. You know what? Just to do the things we're talking about is probably going to be at least another $30,000 or $40,000. Wow. We don't have that kind of money. What'd you just do? This doesn't work. I'd love to live in this house, with all those features. If we could make that here, and in total, if it cost that amount of money and I was going to put my down payment on that, I'd do it. Absolutely. But the way this works, this house is $80,000. I'm going to put down my down payment, but then I need another 30 or 40 grand. So I'm sorry, it doesn't work. Thanks, but no thanks. And then you get to smile again, and you kind of go, I thought you'd react that way. It has to take on. It's a lot of money. But what if you only needed $2,500 to get a $40,000 renovation? You come to the closing table, you bring your additional $2,500, and for that additional money, you're gonna wind up with a team of people that help make that renovation possible. First thing you're gonna wind up with, outside of the contractor of your choosing to do the work, you wind up with a individual third-party construction consultant, an expert in their own right. That's gonna be there to A, make sure that the contractor can't get you and give you a bad bid, but also, once the work is actually being done to your property, to make sure he's doing it right. And before the contractor gets a dime of your money, this guy has to come out and inspect it, just to make sure it's always done well. So it doesn't matter whether this is your 100th home, and your 100th renovation, or your very first, no matter what, you should be guaranteed to get a good result. And that team will be in place to help you get it. Even going beyond that, all of the money to do the renovation, every single dime, for every piece of work that needs to be done, for an inspection that needs to be made, and even a bonus set of emergency money in case anything extra pops up that we could have never foreseen right now, already going to be in the hands of the bank and escrow and taken care of for you. And then last but not least, everything revolving around the work itself, whether you want to be here and watch the swing of every single hammer, or whether you'd rather just do the HD TV thing and show up at the end and go, wow, this place looks great. Can you believe it? Do you remember the first day? We can do it that way, or you can watch the entire thing. It's going to be entirely up to you. But we can make this dream happen. And the only thing that you have to do is be able to put in literally 3.5% if you're doing FHA financing of the property, or if you're going to go conventional, 5%. And that's all. Now at that point, no one in this room will be selling the potential of what this home is. At this point now, we're talking about selling this house today at this list price with a brand new kitchen, with taking care of those bathrooms, with designing the custom master suite with walk-in closets and barn shed, railway door, whatever crazy thing that they're into today. You'll be able to sell all of these things today. And then on top of that, help these borrowers go through the experience of HGTV, but in their real lives. Because I can almost guarantee you, in this room, at least one of you have sat down watching HGTV yourselves, and you looked at these twins and you said, I can do what you're doing. I could even do it better than you could do it. If I had clients that had money, if I had that, I could do it. So now I challenge you. You can. I want you to prove it. I want you to work with Oxford at taking these individual borrowers so that you can address the homes in your marketplace and to help them sell. Now, for those of you that said, hey, look, I'm having no problem getting people under contract quickly. What if, instead of going through the rat race of putting in several offers and just kind of, hey, let's see which one actually stands out, what if you were able to focus entirely on distressed homes? Low competition. Literally, your pick of the market, your pick of the oyster. You're going to show up, you're going to be one of the only people putting in an offer on this thing, knowing that you have that actual path. And in terms of talking about getting these loans closed reliably, because I'm sure the other cat in the room that's kind of dodging in between tables is, hey, we've all heard that these loans are really hard to close, I'm not going to be able to get through it, if there's a whole other problems that arise. I want to tell you, I wouldn't be here, and Oxford would not have tried to be all the way up here from Jersey to talk to you about these if we could not close them. I know we are in the shadow of where the once mighty Wells Fargo renovation machine was, but I will tell you this, even with them running, my organization was already the #2 renovation lender in this entire country, and we weren't #2 based on sheer size. We are no giant conglomerate like Wells Fargo. What we have is a tried and true actual process that works, where we can tell you that we can absolutely get your renovation loans closed and get them closed quickly. In fact, our average escrow time from start to finish is 32 days, whether that's 203K or Fannie Mae Homestyle. All right, and I will tell you this, that 32 days is our average. That's taking everybody from our best to our worst and putting them all together. Our good guys, the guys that are partners with us at the level of Oxford, they are consistently getting it done in 25 days or less. So we can close these as quickly as you need to because we know exactly how to get it done. And we're not afraid to tell your homeowners or your prospective home buyers exactly what they need to hear and exactly what they need to do in order to move through this process and to move through this process quickly. And in terms of what you can do to a home I want you to realize we have two different products, one for the conventional product and another for the FHA product. Both of them have a good 80 to 85% overlap in terms of being able to completely and totally transform the interior of the property. Doing everything from small jobs such as paint scraping, doors, windows, flooring. And of course, in this area, patching some roofs, fixing some foundations because there's a little bit of water damage. We can take care of all of those things up to making full-on structural additions, putting in brand new living space to create new bedrooms or to create that open concept feel that a modern home should have. And we will literally be able to help your homeowners walk through this process and to make all of those things happen. Now, there seem to be a lot of kind of blank stares. I don't think a lot of you are sitting there going, you said snake oil, you said HGTV, you said a lot of things. Well, how much of this is real? So at this point, I need to hear a little bit from you guys. Perfect, a question right up front.
Question, please.
Sure.
I'm wondering, I'm very interested in what you're talking about as far as the loans that are being escrowed for the minimal things needed, instead of having them done mandated before closing. You're saying some of these things can be escrowed to do after closing.
Right, now, yes, and this is true on all of these products.
On all of the products, okay.
On all of them, all right? So one of the major things about renovation that always made me a little bit crazy was when you get an approval back that says, hey, by the way, can you fix those porch steps prior to closing? Aren't we doing an entire renovation of the property after closing? Why on earth am I fixing a window, a door, painting something, knocking out? Why am I doing any of this prior to closing? The very first thing, whether you're using our escrow holdback program or if you're going with either the 203K or Homestyle, all repairs, all of them are going to be done post-closing. So the days of losing a property over a leaky roof or a bad window, that's over.
So my question is, with that, knowing that we're able to do that, are utilities mandated to be on before closing? Because that's something that I run into as a preventative
So you're
occurrence.
working with a lot of bank owners, huh?
Sure, yeah.
All right,
Or
so-
HUD or bank owned, or properties that maybe have been vacant for quite some time that aren't bank owned, that do need some renovation, and you can go into dry rotting pipes and things like that. So when there is an issue of utilities not being able to be turned on because of creating more damage, how are we able to close a property like that if we can do the renovations after that need utilities?
So here's where being number two for a long time at this comes into play. We know this scenario very well. So in many cases, you're going to have instances where if the property is bank owned, you can't turn the utilities on. They will not allow you. They will not get access to turn utilities on, or you have damage that would, if you turn the water on, you're going to flood the basement and you're going to cause massive damage to the property, so it wouldn't work. So we understand that. So we have a process in place, but anytime utilities are actually turned off and there's no, let's say, PCR, if it's not a HUD-owned home where you have that property condition report that tells us whether the utilities were working when they turned them off or not, we have a process. And that process simply is, we want to test the plumbing system. That's the big one. All right, and we don't test the plumbing system by turning on the water. We send a plumber out, any licensed plumber, and they're going to show up with an air can, and they're going to pressurize the plumbing system just to see if it can hold a sufficient amount of air pressure. All right, it's called a pressure test, and we use these on homes that are either winterized or vacant all the time. All right, the only time we can't do that method is if there's definitely an issue where plumbing has been removed, and when a property's been vacant for a long time, some of the copper's gone. It happens. None of us like it, but it's a reality. It definitely happens. We know that if we...
my kids through college, don't
Steve's also from Jersey, as you can see. So the interesting thing, when we can't do the pressure test, we don't throw our hands up and say, oh my God, this is unclosable. We take the next rational step and we say, let's put in the plumbing that's missing, post-closing, and then we're going to do the pressure test afterwards to see if there's still any outward signs that there could be damage to the plumbing system beyond those particular repairs. What we wind up doing, though, to make sure that we have enough money in our escrow to handle problems, we will either A, increase the contingency to 15%, and that's our emergency funded money, all right? But if it's a really small project where that 15% contingency is only going to wind up being an extra $1,000, we'll ask the plumber, what would it cost to replumb 3/4 of the home? if you had to replumb the kitchen and the bathroom, what would the total cost be? And then we would actually escrow that cost, into the bill as well, just to make sure that if these additional problems do arise, we don't have a situation where a homeowner now needs an additional $3,000 and we don't have the money. But that still allows us to close today with a plan to handle the future, as opposed to just, conditioning in a circle, hoping that the borrower goes away.
So if I have someone who has a 203K and they want to close on a home, it is not mandated for them to close for utilities to be on.
Absolutely not.
Wow. And that's for
Absolutely.
all of these products?
All of them.
Okay.
Absolutely all of them. That was a fantastic question. So, all right, work. I like this. Oh, that last part? So the last question centered around, unequivocally, do we require utilities to ever be turned on prior to closing? Whether it's a 203K, a Homestyle, or our escrow holdback program, and the answer is no. We do not require that utilities ever be turned on. That is not required.
That's for FHA or conventional?
FHA or conventional.
USDA?
No, there's no renovation of USDA. That's a little bit of a different story. I'd love to do them. Now, we will do a Homestyle or a K on a farm.
Okay.
All right? The interesting thing about farms is that it can't be a commercial farm.
Correct.
All right? So as long as it's not a commercial farm, we can absolutely do it. All right? If it's a farmer that's buying a farm property and saying, I just want to live here, we don't buy it. I will tell you that right now. We've seen it. I'm just going to show up with a couple of horses. No big deal. But can we put about 30 grand at a stable? No. We've seen those scenarios, but if somebody wants to retire to the countryside and they want to buy that farm home and it's obviously built 40 years ago and it looks like it, we can definitely renovate those properties to full LTVs. All right, but one thing that I'm kind of remiss on, I didn't explain how this prospect works. I brought up the idea that the homes, being able to build equity into them, how that's important. It absolutely is. One of the core principles of the program really is to appraise the properties as if the renovations already happened. So we put our appraiser in a time machine. They go to the future. They take a look at what this contractor's built and they appraise that, as opposed to appraising what currently exists right now. Because we want to know what the property will be worth in the future. All right, that allows us to go over the contract sales price to then finance the cost of making the renovations. All right, so that's how we're actually able to do it. Yes?
Your down payment, is it based on the actual purchase price or based on the total after the repairs are done?
It's going to be based on the total. Now, for everybody here in this room in particular, your actual contract is going to be written up to only reflect the actual sales price. All right, and here's something that's really important, especially for any of you that work both for buyers and for sellers. The seller has zero extended liability over the renovations. They don't have to get any additional writs or warrants on the property. If we discover something new that's wrong with the property, 3 weeks after closing, that is not the seller's responsibility. All right? So that is very, very, very important. I don't want any of you to walk away thinking, hey, my sellers don't want to do this because they're going to start opening up walls and finding out new things and it's going to be an issue. No, it is not. If any borrower were to buy a house and then start working on it tomorrow and found new problems, well, these are the new problems I just bought. They're my problems now. They're no longer the sellers, and that's also going to be true on renovation files, all right? So that is an important distinction to make. Also, going along with that, I want you to realize, for all of you working with some stubborn sellers that don't understand why the home that they haven't renovated in 30 years, why it's not selling at 135 like they want it to, and they're thinking it's your fault somehow. What do you mean? You brought so many people here. Nobody wants this house? Not for 130. 115? No. For this condition, 85. Out of the question. I will not. If you have that seller, I think you should look at the back of this room and talk to the guys at Oxford. Because using our Homestyle renovation program, if they would finance the properties as non-owner, we would be able to renovate those properties and put in modest renovation programs where they would not have to spend almost any money out of pocket at all. Because let's face it, you've probably begged them to renovate the homes, but they're not willing to give up any of the money, and you're kind of at this impossible impasse. I need you to put money into the house to make it sell for this value, and the answer to the money is no, and then obviously your answer to, can I sell this house at full list, is also no. So this is a good way that you can turn that whole thing around and be able to represent your sellers more effectively by helping them get access to financing so that they could actually do these products. Use these products, renovate these homes, and then be able to sell for, a sales price that's more reflective of what they felt that they should have gotten in the first place.
Are your interest rates or other costs to get these kinds of loans a lot more than other competitive mortgage companies? I mean, how do you?
Interest rates are going to be higher on renovation programs by default. All right, obviously, a little bit more risky, all right, but I will tell you this, going by the most recent pricing that I've seen, not a single rate over 5%. And when you compare that to a homeowner's options to finance home renovations, to anything else, that is far superior. You can shuffle and try to get a second mortgage. That's going to be your next closest, board of entry to try to do some renovation financing. And if you're able to get one, and it's going to be a little bit of a lucky feat, you're still looking at 8 to 9% on the interest rate. Everything else is over 10%. Literally everything. So I will tell you this: you're not going to have much of a pricing, comparison issue when it comes down to renovation. It simply put will not be. Also, in comparing renovation products versus secondary liens or let's say non-secured debt from a bank, we're the only product that's going to give them access to the equity that this renovation project will create. So they're going to get access to the future equity to help build that equity. This is some serious time travel stuff that's happening, and no other product is going to offer that. Yes?
You had mentioned about the plumbing. I saw a lot of houses without plumbing.
Oh, yeah.
And you said, we will put the plumbing in so that they can do the pressure test. Who is we? Is it the seller paying for the plumbing?
Absolutely not.
It's the bank taking responsibility before closing, then putting the plumbing in?
So the way this actually works out, we're going to take a look at the existing plan for renovations on the property that the homeowner or potential homeowner, has, and realizing that there's a plumbing issue, we're going to, say, hey, look, you need to, factor in making these plumbing repairs as part of your renovation. All right, so the new buyer is going to be in charge of finding the contractor that's going to take care of doing that particular work. We're just adding it to the plan, that they already have going in to make life for everybody much easier. Now, obviously, being the buyer, hey, now I'm going to take care of another $3,000 of plumbing. It's got to be worth something, Mr. Seller. Please give me a credit. But instead of having to worry about executing the work, potentially finding out that the work is more extensive than initially thought, the seller will be able to walk away, but just issue a closing credit. Hey, so you have a bid from a contractor, it's going to cost $2,500 to take care of the plumbing? Done. $1,200 and $2,500 credit. Knocked out. And the seller gets to walk away. There is no more seller walk away, scot-free program than a renovation. It absolutely does something interesting. And considering you guys have been good, I think it's time to start figuring out what these tickets were for. All right?
Just to piggyback off that. So, say there was something missing, plumbing missing, and that they did want to go ahead and do that utilizing a credit that the seller agreed to, should have not closed. Is that then that $2,500 is coming out of the buyer's pocket now? That's not being funds that are being utilized as escrow, right?
No, well, anything that obviously the seller gives as a credit is going to affect your closing line. So at the closing table, that money is going to be transferred over to the buyer's side. All right, so it's going to be a credit in the borrower's favor, but it's not money that the buyer's coming out of pocket with right now. All the repairs take place after closing. So when we're looking at the actual amount of money we need to put in the escrow, if it's an FHA loan, the way this is supposed to work, if we take a look at the total amount of the renovation cost, so let's say it's $40,000, we're going to actually fund 96.5% of that money if it's FHA, or 95% of that money if it's conventional. All right, so the vast majority of that $2,500, specifically 96.5% of it, is being escrowed into the mortgage, not being paid directly by the seller, by the buyer.
Okay, and then that is also separate from then, see, there were some kind of seller concessions that's not within that 6% rule. This
No,
is
that's
something
going to
different.
be something totally different. So there's seller concession for closing costs is one thing. This is going to be,
Credits are-
this is going to be a credit for a defect in the property, which is
Okay.
entirely different.
Okay.
All right, so, now, one second, there are some lovely parting gifts up here. And one of you is about to win one. And I don't want to, I don't want to make that not happen. So really quickly, pull out your tickets, all right? Because that's an outstanding question, and one of you is about to be rewarded for them. And that person is the person holding ticket 3519844. Look at you. So, you are going to be the very first person to get coffee on Oxford from your good friends over at Starbucks.
Thank you. I appreciate that.
Look at that. Well, I appreciate the questions. The questions are all fantastic so far. And I think we should get right back to them before we, give out all the coffee. So, you have a question too?
I do have a question, yes.
We caffeinated you and now you are ready to go.
I'm ready.
All right, what's your question?
How does the buyer find a reputable contractor?
This is
If they don't have that knowledge.
All right, so we try to make this as easy on buyers as humanly possible. So the first thing I want to tell you is, if they do happen to have a guy, and a lot of people tend to have one, we will actually, do a process where we vet any contractor that the borrower nominates that they want to be the person in charge of the project. All right, so we do have that ability. Every single contractor that we vet, though, us being the sneaky little people that we are, we keep them on a list. So we have a list of contractors that we've already approved and validated in every state. So if your borrower is completely and totally clueless and they don't know where to go, you can always ask, hey, who's on the contractor list? And then we can make that list available to your buyer, and they can pick anybody there. The great news, anybody already on that list is already approved. So it actually makes the bar of entry just that much easier. I told you, it's all this experience stuff. We've just been doing this way too long. Over here.
You said originally that you had a team, or there was a team effort to do the 203K, and now I just heard that you were saying that they could go pick a contractor. I'm kind of confused at that statement.
So the team effort by us
Yeah.
is on the admin side. So, I'm dressed in a suit today. I'm not going to go put on my utility belt and hard hat and go out swinging the hammers. We're going to leave that to licensed professionals. All right? So our team, what we do all of the vetting of contractors. So we look into state requirements for licensing and insurance to make sure that the contractor actually meets those requirements. We also go into making sure that if there's anything that's a little known health or safety code that wasn't addressed in the property, or let's say if it's an FHA loan where there are some HUD minimum property standard issues that aren't being addressed in the bid, we go through everything with a fine-tooth comb to make sure that all of those things are addressed on the back end of it. And then most importantly, once this loan is closed and your new homeowner, they have their keys and their project is coming to life, we are the people that absolutely do make sure that the communication between the actual contractor, the borrower's third-party consultant, and us is all seamless. Because we want to make sure that when an inspection is done, within 4 days, that contractor has to have his check. Because if the relationship between, with the money falls to pieces, this is all over. It's over quickly. I don't know how many of you have worked with contractors, but you miss a payment, not good. They don't like to come back after that. So we have to make sure that they have money on time, and that's what my team does. So my team is all about communication. My team is all about admin, making sure that checks get out on time, making sure that everyone knows the process, and they know what to do. I can tell you from experience, more often than not, we solve problems before the borrower is even aware that a problem existed. But it's just because we don't want to stress the individual homeowner if we don't have to.
Who are the inspectors?
HUD actually nominates a complete list of 203K consultants. So on our webpage, we actually have a link that you can follow to look up every HUD-approved consultant in the state. All right, so that's HUD's own particular list, and anybody that's on that list is eligible. This area, you actually have pretty decent coverage. It gets pretty sparse if you go to like the Midwest. So if any of you are planning on doing homes in Wyoming, hold off a little bit. We can make other arrangements to help you find somebody if someone isn't immediately available. But out here in the Northeast, there are tons of consultants to go around. And since there are so many, that means that you do have the absolute ability to call with your borrower from this list and to find out who's busy right now, who can possibly get to this property and take care of your consulting needs over the next couple of days, or who's so booked up that if the borrower made that one phone call, oh, it's going to take me 2 weeks to get a guy out. There's absolutely not. Let's call the next guy on the list, because if he's busy, somebody obviously is not. And we're gonna go to the next guy up on the list. All right? Yes, you're right.
What kind of credit scores are we talking about to do these renovation loans?
Ah, beautiful question. So, credit criteria. Here's the interesting thing about 203K and Homestyle loans. All of the credit criteria for income, qualifying ratios, all of it is exactly the same as the base program. So for FHA, technically we can do any credit score down to a 550. Now, I would recommend that you keep it north of 620. All right, anything from 620 to 550, you're gonna have a rough time. A lot of overlays down there. All right, it's hard to get out of the basement. Okay, but over 620, you're gonna find this very easy. For the Homestyle, credit score has to be a 620, but if it's a DU approved eligible, we take it with no additional overlays on top of what DU required for income or assets. Wait, in the blue, he had his hand up before too, I don't want to.
So I'm on both sides of it. I own a construction company and I'm a realtor. I've
All right.
done several 203Ks. So you send your inspectors out so I'm waiting, I finished the job, I got my 50% to start it. Now the job's finished, I'm waiting for the rest of my money on the job. You send your inspectors out, or is it someone that the bank hires to send out to inspect? Because they've been traditionally defeated with a third party.
Yeah, so the inspector.
Make sure it's off and then put the payment through, to process the checks and get it on the way.
Yeah, so the inspector always is a third party, all right, and that's important. So my relationship to any contractor is always just solely as payor. I'm the source of the money. You know, we write the check and we send it out. That's all we do, all right? The person actually judging the work is going to be the consultant that was hired by the borrower, all right? That consultant can have no outside relationship to the borrower. So this can't be, hey, my dad consultant is looking at everything and he doesn't like what you're doing. It's a third party that's going to be a professional that's going to, professionally judge your work to make sure it's done properly. All right. Now, the way the payment structure works varies on programs. All right. There are two basic payment types. The way these things work. All right. On the FHA, we have two different loans. One called the Limited 203K, and this is for all of our nice, light kitchen refacing, a little bit of light work to a bathroom, no structural work, nothing major, and the total project budget can't exceed $35,000. All right. That's a Limited 203K. That's the program where we would give the contractor 50% to start the job. And then after the final inspection, after that inspector comes out, takes a look, tells us everything is okay. And last but not least, you, Mr. Contractor, you sign our lien release waiver showing that you're not going to put any mechanics things on the home. We will then cut the check. All right? That check's going to be for the remaining balance, the entire 50% that was left on the job. All checks that come from us are true escrow checks. All right, so this isn't from our accounting general fund where you have to wait to make sure it's going to clear. Every single dollar in an escrow fund has already been pre-accounted to make sure that it's there when the check is written. So these are very actionable checks. We always send them out via 2-day air. So no matter where they go in the country, they always show up really quick.
Your time frame is about 4 times faster than every other 203K.
Well, there's a reason for that. Here's the reason. If you go back a good 7 or 8 years, we're number 2. We stopped doing renovation about 7 years ago. Over one general observation, we sucked just as bad as everyone else. We're just like, this is terrible. As people said, this program is impossible. We can't get through it. We looked at it and honestly said, "You're right. Time out. We're going to go over there and we're going to figure this whole thing out. We're not doing any more 203Ks until we can get it figured out." And one of the very first things that we had to address is what happens to a borrower post-closing. Now, granted, I told you, I'm shameless in knowing my actual customer is Oxford. That's who I have to care about. But his customer is you, and also the borrower. And if his borrower has a home that is being worked on by these contractors and they can't get a check, his customer is not being served. And then obviously that's going to put a strain on our relationship. But then I don't want to have problems with Nick. So the first thing we had to fix was the process of paying contractors. Okay, it had to be streamlined, which is why for us, it is a 2 to 4 day turnaround to get the check out. It takes us 24 to 48 hours to process an inspection report, and then after that, the check must be in the mail. And all of our checks come out of our corporate office and our accounting. So there are no third.
I believe the reason he made that statement is that I'm only aware of 2 or 3 203K inspectors in upstate New York, and I just happen to be one of them.
Look at that.
So I'm kind of confused. What he's saying is absolutely correct. The old way is you may as well, put the oars up in the water and float around till you get your check, because you're gonna try to find the guy is gonna be a hard day's night. And so where are those inspectors coming from?
Well,
I'm lost.
we have another third-party company that we're using whenever we have an issue with coverage for consultants. All right, so they actually have a pretty, it's not as great of a report as the actual HUD software generates, but we work with them to make some enhancements and some tweaks that makes it very close. So whenever we need to, if there's a coverage issue, by all means, that's the well that we're going to go to as necessary. I don't want you to feel that we are trying to steer people away from traditional consultants. Not the case at all.
Guys, we've done loans in states like Wyoming that have no HUD consultants.
Yeah, we've literally, our first call is always, through our contacts and consultants that we work with on a fairly regular basis, the first thing that we'll always do is kind of go, if we paid you a little bit of extra money to leave the state, would you? And, when they say yes, we will absolutely make those things work out. So consultants are absolutely, the actual HUD consultants are our most consistent source. We certainly don't want to poach anything from you, but when you guys are overwhelmed and you just can't get to people, we certainly don't want people to give up in the process. So that's when we have to go out to these third-party sources. And by all means, if I can convince the third-party sources to go through the HUD process and to join you, well, you probably wouldn't like that either if I brought in a bunch of consultants.
I would relish the thought of other people wanting to step up to that plate and take the exam and be an inspector, because it deters the loan. We as realtors can't get people to do it because
it's difficult.
the process is not good.
Yeah. And for all of these things that are issues with the process, that are kinks in that armor, when we took our program down, we rebuilt it with these things in mind in particular. These were all of the areas that needed to be improved in order for us to do this. Because to do this, we decided we had to be the best. And I stand here in front of all of you, defiantly saying we are. And we have been for a long time. Yes?
What if an inspector approves a project and it comes to find out that the project is not done correctly? Who's responsible for the correction?
Oh, so Tuesday, these things happen. You'll have an inspector that looked at the plan, that absolutely knew what was supposed to happen, and shows up and the work is done in a different manner and it's not going to work. The responsibility for what the contractor does not fall on anybody in this room. Not us, not any of you. We're going to work that out with the borrower. All right? If they were working under the borrower's orders to make changes and they were just trying to get through it, we're going to actually go through each individual situation, figure out what actually happened, and then we're going to assess whether the borrower has the ability to help get it fixed. And if not, then we're going to take care of it. All right, but we have an investigation process.
Is there a time period? I mean, like say something a month later it falls apart, whatever is being repaired, and
Well,
what?
you're asking a warranty question.
Yeah.
There has to be a warranty on the work, absolutely. And I will tell you this, more often than not, and I'm sure you can tell me about this, consultant walks into a property and sees hack work, they know it the moment they see it. And they do the, no. And they would not, tell us to send final payment on any project that looked like it was poorly done.
They're
And we
paid
would-
by your company?
Yes, we are the ones that handle the funds. That is our absolute job. And it's up to that team of people, the consultants and everyone involved, if we see non-quality work being done, to stop the payment process to make sure that it's addressed and done properly, because at the end, the borrower's got to be happy. Now, I'm sorry, back there.
My turn.
Yes. She has been waiting.
So this is a great program, but my question is can this be leveraged with other programs that are available, like the county lead program, or the city has a window program now, you get the windows, but you have to have financing to be able to have them installed in your house. So can you leverage that now?
In many cases, we can. I will tell you this, when it comes down to specialty programs, market by market, there are so many different things. I can't tell you unilaterally yes to everything, but if you gather the documentation together and we can take a look at it, as long as it doesn't create any issues between HUD or Fannie guidelines, more than likely we'll be able to work it out. All right, but we just have to make sure that it's an actual fit that does not impede on A, our loan obviously, or B, create an unsellable loan situation by its presence in the loan file. But as long as that's not the case, it'll work. Okay, we have 2 questions, 3. Actually, this is your first, so I'm going to let you go.
I don't have one of those Property Brother CAD CAM things that drops everything down into place and gives everybody a really good idea of what this is gonna look like at the end. One, does anybody in this whole contracting business have one of those so that people
Some
can actually
contractors,
get what they're
those are gonna
expecting?
be large shops that have that, that have that ability, and they may not be
Okay.
absolutely willing to just kind of give those out for free. But even in this particular marketplace, you do have a source that may be willing to give you designs on what these homes could look like. And they're interior designers.
Okay, and then the second part two, is in the offer writing process, who's guesstimating the costs of these? Because obviously, you don't pull this whole crew in before getting an offer accepted. So, like, are we just ballparking that,
What I would always recommend that you do, instead of, especially when you're uncomfortable at the very beginning, one of the first things that you want to do is to find a contractor to query, just to say, look, I'm a real estate agent. I'm trying to sell some of these distressed properties, and obviously they're going to need some work. All right, so if you work with me a little bit, I can, at least recommend you to to the homeowner. But tell me, if I needed to put in brand new bathrooms, just everything in there, ripped out, new kitchen, and did this work to this property, because I think if it's done like this, it'll gain a lot of value, what the price tag on that work would be. And that's the information that you're going to take and you're going to use. And by all means, to all of you, any great tradesmen that you see in the market, they have a great reputation, people love to work with, you need to befriend these people. Because in all certainty, I will tell you this, if you have relationships with them, they fill out paperwork more quickly, they correspond with you a lot more easily, and you'll be able to help your borrowers or your potential homeowners walk into the situation with at least a sense of familiarity. When you're actually able to make that introduction. So you do want to do that little bit of extra homework up front so that you can understand overall the amount of money that's going to go into homes in the marketplace, so that this way when you're making your offers, you'll be able to make them intelligently. And here's a little known secret weapon that I want everybody to walk away from knowing that you can use. All right? And you got to turn around and you got to look at everybody from Oxford, because they can do this for you. Through Oxford, you can get us to actually give you a real TBD approval. So that means we'll approve the borrower in terms of credit, assets, a full underwriting approval, minus the address. So if you have a borrower that's shopping, they have the ability to figure out the maximum debt load that this borrower can handle and to give you an actual commitment that they can shop with. Not a pre-approval, an actual commitment. We are that crazy.
And the important thing about that is when you actually find a home, you're not starting the loan over. Oxford is just going to upload the 1003 with the address, and you keep going. We'll just keep underwriting that file as if we knew what the address was the entire time.
So
And
that,
buying the home does not slow things down at all.
and with being able to do that you're a little bit of homework up front, structuring a great offer, putting it together, sending it over with this, look, this borrower's already approved with this type of budget. I can get them $150,000. However, to make this $150,000 work and to do all these renovations, we can't offer you more than X. This is what we can offer you, but they're already approved. They're not pre-approved. We've already lined up the money. And that makes it so that you're almost offering just as good of a solid offer as cash. And let's talk about those cash offers and those cash buyers. There's something that we don't talk about. They're flaky. They tend to find reasons to back out of buying things because they're putting up cash. And when your borrower is emotionally invested, they're not flipping this property. They want to live here. They've gone through the painstaking process of talking to a mortgage person, of talking to you, touring these homes and putting this offer together. If they have an approval on the home, they have an agreement to purchase the home, and the money's already lined up, they're going through it. So your offer is going to be more firm than a lot of the cash offers that sellers are looking at. Because you have not investors, but home buyers that are emotionally invested. And you cannot take a discount off of that. So for that little bit of homework, and looking at homes that are going to face a lot less competition, and homes where you're helping your borrowers absolutely, positively save money, to get the custom home that they wanted, to give them that HGTV experience, You are literally putting together something for them that maybe they thought was never possible to do in their lives, that they could only do on their couches, watching HGTV. So I say, screw those twins. You guys can do it. All right? You can totally do it. Before I go to another question, I think someone needs more coffee. All right? So let's do one more ticket. And this person has listened to me this long, and they're rewarded with caffeine, and they are the holder of 351-9859.
Really?
In the back, you got it? Look at this. All right, everybody. So, yes.
How difficult is it, what's involved in getting a contractor vetted with your company? I mean, how burdensome is it for the contractor to do that?
So contractors hate filling out paperwork, right? So of course we can fill out paperwork. There's an actual one-page questionnaire about their business that they have to fill out. All the questions are about themselves. Name of the business, type of business entity that it is, name of the owner. They have to fill that out. They have to give it back to us with their licensing and insurance information. What we do behind the scenes, we go through that information and we check it against state requirements, and it takes us 24 to 48 hours.
Okay, because in New York, contractors aren't licensed.
Some of them aren't, and those are a problem. You see, anybody that doesn't have a real business, but let's say at the first hint of trouble, kind of packs up and moves on and stops answering the phone, we don't like those contractors. They present a problem for us, especially if they have half of the borrower's money already. So if they're not licensed, they don't have a real business, no, we really don't want to work for them. So
But we don't license in New York State.
no, you do.
All right, so come on,
You do. So-
into our area, Gates County.
I do a lot of business in the Albany area, and general contractors don't have to be licensed, but they do have established business and provide,
Yeah, and
we can provide, trade references, referring preferences, all those kind of things.
And we do go through
Owners
everything.
do need to be licensed.
All right, I mean, master trades always need licenses, so HVAC, plumbing, electric. You always need licenses for those particular things. Half of the states in the country don't require general contracting licenses. So when it comes down to each individual market, we take a look at it, we see what the norms are, and that's kind of what we go by. All right, so if the guy's been operating successfully, we have a track record, especially if he's worked with us in the past, and he's operating and it's never given us an issue, that's not a person that we're going to question or put through the ringer. All right, so we're very flexible when it comes to those things. In the blue.
Mine's more of a statement. I just hope everybody here realizes today with the inventory that we have, what a huge value there is in your tool to take advantage of, because we have to look over all these properties that need everything because all the business is gone to ours. So it just really opens up to
Well,
an option for them to go.
I want to say two things to you right now. A, thank you. And B, it'd be pandering to give you coffee right now, but I really want to, but I
I definitely don't need it. But no,
Over here with you.
Could you talk a little about using the Homestyle loan as an investor?
Oh, the Homestyle. Beautiful, beautiful product. All right, so this is really interesting. Typically in our business, we don't really work with investors too much on the mortgage side. We kind of think that we can't really help them out. But since we're talking about using renovation, we can leverage more than just the purchase price. We can also start looking at renovation costs, which do help out investors quite a bit. On the Homestyle renovation program, we are limited to working with single-family properties only. All right, so that's the one down. All right, no multifamily. But on those single families, if it's a purchase, we can finance up to 85% of the combined cost. All right, if it's a property that they already own and it's a refinance, we can do 75%. What this virtually does is eliminating all of their spending on the renovations, which means as a small-time investor, or even if they're an incorporated investor, the way that their business actually operates, based on cash flow, they are limited to the number of properties they can work on at a time because they have to consistently spend money on renovations. But if you can help them largely make that part of their budget go away, all of a sudden they are free to do one thing: buy more houses. And I think everybody in this room in particular would like it if investors wanted to buy more houses, if they had that actual capacity to work with more homes. So by using this program, you can definitely leverage that. All right, and the process works largely exactly the same. We find a consultant, They get a third-party contractor. No, we are not going to allow an investor to be their own contractor and manage a project. That's asking for disaster, and we try to avoid disaster, so let's just put that out there right now. But in general, the money's going to go into escrow at the time of closing, and at that point in time, this investor is no longer required to come out of pocket for anything on that property until the work is finished. Plus, during this process, this contractor is going to wind up with a Fannie Mae appraisal showing the property's post-improvement value. When else in real estate investing has an investor ever known the property's final value prior to purchasing it? It makes any property not worth investing in apparent up front, and the only cost in finding out is the cost of an appraisal.
Is there a minimum loan amount?
There is not an actual minimum loan amount. My company, we don't have to do car loans, so if it's less than $50,000, we probably won't do it. There's a lot of work that's involved, and you can't really charge fees for a $50,000 loan, but there's no minimum amount, all right? Even on the actual dollar amount for the work, I mentioned unlimited 203K earlier, how it has a maximum ceiling in terms of what we can actually finance in it. It's Big Brother, the standard 203K. There is no maximum limit in standard 203K. The limit for what the renovation repair escrow can be is the county lending limit in that particular area. All right, the Homestyle is a little bit different. On the Homestyle in particular, we are limited to the amount of money we can put into escrow by the actual appraisal value. So if you have a $200,000 appraisal, the actual limit to what we can put into the repair escrow is going to be 50% of that appraisal value. So that would be $100,000 in that particular case. All right, but it's always going to be 50% of the final, actual appraisal value. All right, but that's it on, limits. Oh, my friend up in front.
So for some of these Rochester City bank-owned properties that I have investors who are interested in, but because of the financing portion of minimum loan amounts, a lot of these properties are $20,000 to $48,000. I mean, they're right below 50, and they sit vacant because people don't want to spend the $25,000, $30,000 cash, but they seem like they would be perfect renovation homes that could really revitalize the city in areas that are necessary.
You want to go ahead?
I'm a broker who does a lot of business in Baltimore. Okay? Anybody ever seen The Wire? All those neighborhoods are now full of $400,000 what they call townhomes. I know them all. They're rubble. So I do a lot of those business. And yes, they're buying them for $40,000. They're buying them for $50,000. We're not lending them $50,000. We're lending them the finished amount, which in this case is probably going to be $80,000 or $100,000. So that loan amount is going to go up. So you're going to buy it for 40, put 30 into it, it's going to be worth 100.
So
contract has to read the price that you in the offer.
No, your contract is just with the sales price. You're out. That falls to Oxford. They're going to do the work.
Got it.
So they're going to do the work. Your contract, if the city is selling that house for $30,000, that's what your contract's going to be.
Right,
You're not
so
going to be able to sell that house.
Now the loan limit's up to where you need it to be, though, by doing that.
So the loan
Contract doesn't matter.
limit, your sales price is below what we want to lend. But the actual loan amount, when it's done, is above our minimum loan
with
amount.
renovations. So
And just to let you know, I do a ton of those. I've done loans on basically, because Baltimore is set up where if you renovate a vacant, it's something like you don't pay taxes on it for up to 5 years or something like that. So I've done houses that are basically shells. There's no windows, there's no doors, it's a shell, it's boarded up, and we've taken that and turned it into, in that neighborhood, it's now worth $400,000, and they bought it for $100,000. But in an area here, if it's a neighborhood that's not, it hasn't come gentrified that much, if it's worth $35,000, when the work's done, it's going to be worth $80,000 all day long. You can move that property all day long.
So with that, so with what you said in regards to that, if someone would like to go ahead and purchase a $30,000 home, well, what if it appraises only at $25,000 and now they're able to use $12,500 for that renovation, or how would that work?
Well, here's what you have to look at. Okay? We're going in our time machine. So we're never going to be appraising the property based on what it's worth right now.
Based off the finished value.
So based off of the finished value. All right.
Okay.
So what you're putting into the property is you have to kind of take a look at the marketplace and say, all right, these homes that are challenged, that have issues, here's what they sell for, but what are the market move-in ready homes selling for? All right, and if you see the value being there, that's when it's okay to move on to it. But let's say you're in a particular neighborhood where you've noticed properties are selling for 28, and even finished, they only sell for 50,
Right.
then you realize, all right, we gotta do a very tight renovation on this. All right, because ultimately 50 is gonna be there's gonna be the number that we're factoring off of, and that's gonna be our limit. So it would be not smart to tell that borrower to go spend $40,000 on the home,
Right.
whereas the renovation is worth more than the home already. you know,
Correct.
So that wouldn't make sense, all
Okay.
right? But let's talk about, in limited cases, the 203K does offer you some protection from that, all right? On the 203K, we are actually able to take the actual appraised, value, all right, post improvements, and then we can still go over that by an additional 10%. So let's say if on that particular type of home, it was a $28,000 purchase, even after we do a $15,000 renovation, it still doesn't have everything, but we're maxed out. Since it's going to be a $40,000 appraisal, we would still be able to factor an additional $4,000 into it to try to help make it work. All right, the 203K program is very friendly to bank-owned properties and doing maintenance work. All right, because they already understand that flooring, windows, and roofs, those are all things that every home needs to have, and they can be expensive. And by doing them, we don't have value. The home just has to have those things. So the 203K program in particular is very, very good at adding those things in.
Okay.
All right?
So if someone wanted to buy maybe more than one of these small $30,000 homes on the same street as an investor, is that something that potential bundling, or because it's such a low?
We have, overall, our guidelines show that you can only own 4 properties at a time, right? And that's the total number 4, not for finance, but 4 properties at a time. All right, so you don't want to get into, all right, we're going to put in 3 contracts right now, and I have 4 other homes, and that's obviously going to be a little bit much. All right, so the thing that the most successful investors do with us, they're incorporated. So they like to leave the actual corporate entity on title. All right, and as a bank, we are fine with closing the corporate entity on title as long as we have a human guarantor. So the members of the actual corporation themselves take on 1 house at a time, round robin, and they always leave the actual corp on title as well.
Sure.
So
Right. So
corporations
if
don't.
someone wanted to, are they able to buy 2 as a bundle of these
Initially,
small?
first starting out, you'll notice our guidelines say we limit ourselves to, to 1 transaction at a time, especially when we don't know you. But this is one of our own individual overlays. And as Steve can tell you, one of the things that we are very good at is being flexible and looking at situations and realizing when someone's a good bet. So if your investor came in, did his first loan, no issues, no problems, no funny business, everything was great, and they came back with their second one and went, by the way, there's another property that I also want to buy concurrently, it's a great deal, can we put it through? That's something that we could work on getting an exception. All right, but we're always very upfront about telling you, when something needs an exception. And as Steve can definitely attest in the back, Steve, do we make them submit the loan to find out if they can get the exception?
No. No, to submit the loan to find out if you get an exception, regulation not. You're gonna give me all the information, I'm gonna take that to management, you're gonna find out what's going on.
So if it's not going to work, prior to even taking an application, we'll be able to tell you.
We kind of believe the best part of the commercial business is if there's a no, let's get to it fast. Nobody wants to find out 60 days from now the deal.
Absolutely. All right, so, was there another question out there?
We're afraid there's a lot of second homes in the area that were damaged due to recent flooding and water. Can you just touch on the fact that we also do second homes with these?
Oh, second homes. This is going to be another Homestyle situation. So the interesting thing about second homes is that we had the ability of both purchases and refinances to go up to 90% LTV on a secondary home. And let's face it, if you have clients that own secondary homes that they purchased 10 years ago, how often are they putting their own money into fixing these properties up? It's not often. So they wind up becoming rentals. And then they're not even rentals that you can help them get rented often because it's not the nicest house in the block. Or it's, it needs a little bit of work, and it's just this never-ending cycle. You can go back to all of these clients and say, hey, look, I know I've been helping you rent your summer house. It's not really going all that great. I just looked at the value in the neighborhood. I could get you a $40,000 renovation and you pay almost nothing out of pocket. On the Homestyle, it's a very, very healthy refinance budget. We go totally off of the property's post-renovation value. So if they've owned a home for a couple of years and they've already built equity into it just by owning it for that duration of time, and then we're going to do renovations that will add and enhance that equity, more than likely the entire cost of the renovation will be covered by the loan without them coming out of pocket at all. Which does two great things. A, it gives this particular client the ability to use their summer home as a summer home again. And then B, when you're representing them to help them find rentals for the times when they're not using it, oh, it will rent much more quickly. So it helps you kind of in two folds. I hope all of you are kind of picking up on the idea that I'm trying to help you all make money, to kind of go back to the beginning where we started. Yes?
Can the investors use it as a fix and flip product?
Absolutely. All right, so here's one of the things that maybe Oxford doesn't want me to tell you. Typically, when we do a loan, we make them promise to us that the borrower is going to stick around in this mortgage for 12 months. We make a promise. We kind of hold them to it. We even have a whole agreement about it. It's called an EPO. All right? That's why typically you won't see LOs talking to investors, because we know investors kind of want to sell homes. Holding on to them for a year isn't really an option for them. So with these particular programs, we decided, again, since rebuilding everything from the ground up, the EPO on these loans doesn't make sense. It just doesn't, especially for the investor. You don't want to restrain your investor from selling or making money. I'm here to try to help everyone figure out how to make more money, not less. So your investors are not required to hold the homes for any set duration of time after closing. Once the work is finished, they can sell at their heart's content. In fact, you wouldn't be much of an agent if you aren't already relisting it for them, if it was your investor. So I wholeheartedly want you to be empowered to, once you know that the paint's going to dry, the final nails going in over that doorway, hey, let's get this thing relisted and let's work on it. In fact, you have Oxford's blessing, I guarantee you.
So you don't have to live in it?
If you're an investor, no, not at all.
But you do us to bring it back to Oxford Capital where we sell it, though.
Yeah. I will tell you this. Even your owner-occupied borrowers, anybody that's a little bit more rate conscious and said, hey, look, 5% is great, but I can finance and get it down to 4 1/4 or 4 3/8. We don't want to even hold them back. So provided through Oxford, if they bring these customers back to us, once the paint's dry, we will allow them to refinance out of the initial lien and then get into conventional financing if they so choose. Many of them will start off with the FHA product because it was the one that made the most sense at the time. But after the equity that was gained, if they have a 75% LTV, they can go conventional, completely drop a mile from their lives, and then wind up with a custom brand new home that made possible by you, and realize that they have the best house on the block and the best financing.
That's real term.
Absolutely. If you help them put it together, that's truly it. And to know that you're the best realtor is something that's important. And there's a good bit of prestige that's been lost from all of us. All right, we all took it in the chin really hard about 10 years ago. It's rough. There was a couple of there was some time where we couldn't talk about being in real estate without customers. They give us the same thing. Give me your LE. I'm going to look at incremental fee numbers, and I'm going to pick the lowest number, and that's it. All right, because we're a commodity to a large degree. We're all professional. We're not a commodity. We had pride, and this product helps us bring it back. Use your actual expertise of the market. Do that little bit of extra homework. Put together packages that are compelling for these homeowners or these potential homeowners with information that, sure, they could have found in Zillow, but Zillow can't help them organize and analyze that data to make an intelligent decision. That's what you can do. And that's what makes you a professional. That's what makes you worth that 6%. Right? And I just want to help you get to that number far more often than not. That's my overall goal. That's their goal. And if we all look around this room and work together, we will help each other get there far more easily than we have been. It's a challenging market. Guaranteed. I'm not going to sugarcoat that. But it's not like we don't have the tools to continue to thrive. So what to do that? Thank you, everybody.